He's able to log on. Maybe we're getting to that point now, so I'm happy to go ahead and welcome everybody for joining us today for learning about leaving a legacy. We're thrilled that you're with us and appreciate your interest in SAHC and in this topic. And I'm thrilled to be able to introduce Sheryl Aikman, who many of you may already know. Sheryl's had a distinguished career with the Community Foundation, and we worked with Sheryl on many exciting and really beneficial kind of projects through her role there at the Community Foundation. And we're thrilled when Sheryl joined our board a year or so ago and is now serving on our executive committee. So she is a trusted advisor in our region and really across the country. And I'm happy to be able to introduce Sheryl for discussing estate planning techniques and tools and leaving a legacy for the future. So thank you, Sheryl.
Thank you, Carl, for that introduction. Let me back up one more. Well, we can start here. We promised these items. We promised 3 important questions for your estate planning, and we promised 5 things to think about when you think about charitable giving through that process. So I hope to deliver all 8 of those items for you. And I encourage you to put any questions that you have in the Q&A or in the chat if you all have, I think you all have access to that as well. And we'll circle back to those at the end of the presentation. And I look forward to making this more of a conversation as we work through the presentation. So without further ado, we're going to go to the first thing to think about, the first of these 3 steps, which is, do you have a will or a revocable trust? Now, at this point, I don't really care if your will has a charitable gift in it. I want to make sure that you have the planning that you need in place to have your wishes carried out in the way you would want. A part of this process is not even having a will or a revocable trust, but it is having a healthcare power of attorney and a financial power of attorney. Typically, when you create these sorts of when you create some estate planning documents, or when you visit an attorney to do this, those documents will be part of what they help you put in place. Those documents allow decisions to be made for you if you are unable to make them yourself. And it is so important to have those in place before you need them. It is critical for your wishes in that regard, and also for your family to be able to carry out the financial transactions they may need to, or to make healthcare decisions for you in the way you would want them to be made. These documents allow those things to happen. In addition to that, having a will or a revocable trust tells the people who be carrying out your business after your death what to do with your assets, as well as what to do with your material goods. That could be your home, your possessions, but also the different kinds of accounts and other things that you may have. Many people also like to include with those documents other kinds of instructions. One thing that lots of us have thought about adding to those instructions is what to do with all of our online presences, whether those are a Facebook account, a Twitter account, a website that you run. Those sorts of digital assets are increasingly part of what we all need to include instructions for as we consider all of the things that will have to be handled by our families after our lifetimes. So having a will means that you decide these things as opposed to leaving those decisions to your family or allowing the state, particularly with regard to assets, and the government to decide for you how your resources will be distributed at the end of your lifetime. The second piece, number 2, is, let me just advance, are beneficiary designations. The picture here is for a generic IRA account, but lots of different assets require you to name in your account documents a beneficiary. These assets don't pass according to any instructions in your will. The instructions that control these kinds of accounts, retirement accounts, life insurance, some other kinds of financial instruments, are dependent on the information on this beneficiary designation. So it is a really good practice to, first of all, make a list of these accounts. Make sure that you have a up-to-date listing of where these accounts are and who holds them. And then to make sure that these beneficiary designations say what you want them to say. For most accounts of this type, if you want to make a change, either the person who sold you the instrument, the retirement plan or the IRA, can do that, or you can log on online if you have online access and get a beneficiary form and make that change via the online portal that you use to monitor your account. Charity can be named as one of your beneficiaries, and we'll talk about that. But for the purposes of these first 3 slides, what I really want to emphasize is making sure that these forms name the people or the charities that you want them to name. And perhaps also talking to your professional advisor about whether that is the most strategic in the sense of asset transfer and tax for your situation. The third item in this is to think about your family members and to think about how you want them to be taken care of. When we make an estate plan, family members come first, their security, the provisions that we need to make for them, financial and otherwise. And that is where the place all of us start from. Once family members are taken care of, then you do want to think about any obligations that might need to be handled, and your executor will need to take care of those. And then lastly, to think about, are there ways that you want to leave a legacy for a charity or for an important cause in the context of your estate planning? And that's what we'll spend the rest of the time really focused on, is ways to do that. I tried to include as many different kinds of families as I could find, and your family may or may not look like any of these, and your family may have many generations or only a few, but caring for family is one of the most important things that we do with an estate plan. So, as promised, 5 ways to establish a charitable legacy. We're going to see a familiar picture, and that is that IRA beneficiary form. it is possible to name a charity, a specific organization, as a beneficiary on an IRA, a retirement account, or an insurance policy, and to name them on this form so that the organization will receive a distribution of those assets at your death. You can name a specific dollar amount, and you can name a percentage. You do want to make sure that you talk with your professional advisor, your attorney who's handling your estate planning, your financial advisor, your insurance professional, so that you achieve the distribution of assets between people and organizations in a way that will be possible to carry out, and that doesn't create unintended tax consequences for you or for others. Some people find that a great way to do this, to include a charity as a beneficiary, is to either create a separate IRA account, for example, or to use an account that is the size of the designation that they'd like to make in terms of assets, and to name the charitable organization as the sole beneficiary of that particular account. Makes it a little bit cleaner and makes it simpler to be able to see what the value is as the value of the account changes of that potential charitable distribution, and to know that what the charity is going to receive. Some people call that an orphan account. I don't particularly like that description, but again, it would just be in an account that does not have any people as beneficiaries, but where you simply make your charitable distributions there. Now, there have been some changes for how our beneficiaries can receive assets from our IRA accounts in particular. And we're going to talk about that later as well. So for any of you who are aware of those provisions and curious about them, just know that we are going to get to them shortly. Including a bequest in your will or your revocable living trust is a way that people have been giving to charitable organizations for literally hundreds and hundreds of years. This is the most common way to give to charity until we invented a complicated tax code and all sorts of other ways to do it. A bequest is simply a direction to your executor to provide a specific asset, a specific amount, a percentage, or even to follow all of your other distribution instructions and then provide whatever is left to an individual or to a charitable organization. And there may be specific assets that you believe will be best suited for this. Again, your professional advisor can help you determine the best strategy for your particular situation. But including a charitable provision as that whatever is left provision is a really effective way to know that I've included charity when all of those other people are taken care of and other assets are distributed. If there are resources left over, a charity can be included. You can do this as part of an update to your will if you're looking over your whole document and perhaps restructuring it. Some wills will allow you to add a codicil. It all depends on how the overall document is written, and you want your attorney to include that in the way that makes the best sense for you. If you need language to provide to your attorney, to include in your will or in your trust, that's available on SAHC's website, and you can provide that example language to your advisor for them to integrate into your particular plan. We're to number 3. These are perhaps assets that you haven't thought of as you think of your estate planning and of the things that you might decide to give charitably at the end of your lifetime. There are lots of assets, typically the kinds of assets that we think of as being held in banks, that can be assigned to charity only at your death. So only if you don't use these assets during your lifetime would they proceed to be distributed to a charitable organization. This is called payable on death or transfer on death. It doesn't cost anything to make these provisions for these assets. If you use them in the meantime, if you use them during your lifetime, then the instructions are invalidated. But if any of these assets are left over at the end of your lifetime and have those instructions, they can proceed directly to the charity of your choice. So some assets to think about in this regard: savings bonds, which have a tax consequence if you cash them in during your lifetime. Those make excellent charitable gifts at the end of your lifetime. Accounts, you can actually put instructions on your bank account to make it payable on death to an organization. Certificates of deposit, we think of that as being part of a bank account, but that's a separate instrument. You can add those instructions to a certificate of deposit if anyone's using those. They're not the instrument that they used to be. Also stock accounts. If you're currently using a brokerage account and want to leave those kinds of instructions, you can make a transfer on death instruction, and that instructs your broker or your brokerage to transfer the assets of a particular account to the charity of your choice at the end of your lifetime. Again, the part of the advantage of this way of giving is it doesn't cost anything to execute now, and it doesn't prevent you from using these assets during your lifetime. You can avail yourself of these assets as they're needed, but if for some reason you don't need them or you don't use them, then they become part of your charitable legacy. Number 4, a gift that pays you income. Now, some of you probably have heard of this way of giving, and for some, perhaps it's a new concept. So I'm going to take a little time over it. There are charitable gifts that you can make now. You receive a tax deduction, a charitable tax deduction, and the opportunity to receive income payments for the rest of your lifetime from this particular kind of instrument. The charity or the organization that the charity uses to manage this type of gift invests and manages the gift that you make. From your gift, the income payments are provided back to you. At the end of your lifetime, whatever's left in the account is the amount that's then distributed to the organization that you've named. The advantages of this include the ability to make a significant gift now, perhaps while you're in a higher tax bracket or have income that you'd like to offset with a charitable deduction. The opportunity to lock in guaranteed income payments. In the interest rate environment we've been in for decades now, we all know that earning money on our assets in the bank comes in very, very small increments. And typically, charitable gift annuities can increase the amount of income that you receive from a particular asset. If you use appreciated property like stock or mutual fund shares to fund a charitable gift annuity, you not only receive the charitable deduction, but you avoid paying capital gains taxes on the transfer of that capital asset. It provides an extra deduction. It's also a way to provide for others. You can make a gift that provides income payments to someone else. Let me give you an example. I worked with a donor who cared deeply for a particular charitable organization, but was very concerned about their brother. Their brother hadn't had the kind of financial success and security that they enjoyed. And this particular donor was very concerned about what would happen when if they were no longer alive, to provide the occasional financial support to their sibling. We were able to structure a gift that provided a modest quarterly check to the sibling, and it was guaranteed for the sibling's lifetime. So the donor didn't have to worry about if they died first, that their brother would be left without any means of support. And also knew that at the end of their brother's life, the donor's favorite charity would receive an additional gift. So it created a whole series of good things. It created a charitable deduction for the donor, which was a good thing. It created peace of mind for the donor, which was a better thing. It creates a gift for the charity, which will be impactful and important for that organization. And most of all, and this was unexpected, but something that I've never forgotten from this particular transaction, it provided real dignity for that brother. He had accepted financial help from, in this case, his younger brother for a long time, but it wasn't easy for him to do so. By setting up this gift, it put some separation between those payments and their sibling relationship, and really allowed that relationship to change and grow in a way that was healthier all the way around. And that wasn't an outcome that we named at the beginning as an objective for that gift, but it was a very, very important one for the lives of the donor and that brother. And I was really honored to be a part of that and to know that we had helped create that dynamic. To give you a sense of how a charitable gift annuity works, you can create a gift like this typically with an amount of $10,000 to $20,000 or more. There are gift annuities created all the time that are multiple millions of dollars, but they really are a way of giving that's accessible to all. If you are 70 years old and you create a gift annuity that will pay you immediate income, you would qualify for a rate of 4.7%. So because I can't do math in my head very well, I'm going to say if you made a $100,000 gift and established a charitable gift annuity, you would receive payments of $4,700 every year for the rest of your life. A portion of that comes back to you tax-free, and that is an income stream that will never change. For a couple who are both 73 years old, the rate would be 4.4%. And we can model or provide more information about this way of giving to you at any time. But it is an especially effective strategy for those who have assets that they are ready to give, but also need to retain income. Let me go forward. You can also make gifts of things that you own. And you can make these gifts during your lifetime or from your estate. And it's important to think about all of the things that we own as we think about the charitable impact we want to have and how that might be structured at the end of our lifetimes. A house or a vacation home. Maybe you have a business or a business interest that you've retained or plan to retain even after retirement. Many people own valuable art. I don't think the Mona Lisa, which is represented in this graphic, is out there for giving, but valuable art or collectibles. And even that little B, you may not know, that's the symbol for Bitcoin. That's virtual currency. We actually are beginning to see charitable gifts made with virtual currency as well. So thinking broadly about your assets, not just the things that are held in bank accounts or brokerage accounts or retirement accounts, but all of the things may provide an avenue for a larger charitable gift than you thought possible, a larger bequest, and a more significant legacy. Sometimes we need help structuring these kinds of gifts. And that's one of the ways that I'm happy to support charitable organizations like SAHC and others is by being a resource for structuring those types of gifts for them and for their donors. I wanted to speak to a few special opportunities that are going to come about as the year ends. There have been some legislative changes and some, particularly some pandemic-related changes to some aspects of charitable giving that will be important to keep in mind as we go into these last 6 weeks of the year and as you think about your giving at the end of the year. So, gifts from your wallet, gifts that you'll make with credit card, with a check, with cash. I don't know that anyone really sticks cash in an envelope, but maybe. Know that beginning this year, everyone, whether you itemize your taxes or not, so whether you'll be listing other charitable gifts and taking a deduction for those among other itemized deductions, or whether you take the standard deduction, everyone has the ability to give up to $300 and take a deduction for that gift. This is a way to allow non-itemizers, folks who use the standard deduction, folks at every income level, to make a gift to charity in 2020. This will go forward after this year, but this is the first year you've had the ability to do this. Let me emphasize that it's a $300 contribution per what's called a taxing unit. So if you're a couple filing jointly, you still can only give $300. You don't get the opportunity to give $600, but individuals, couples filing jointly, heads of household, itemizers or not, can give up to $300. That can be cumulative charitable giving, and take a deduction from right off the top from their taxes for that. The other important thing to know for 2020 only is that for cash gifts directly to organizations like SAHC, you can deduct that gift up to 100% of your adjusted gross income. Normally, and again in 2021, there's a limit. You can only deduct 60% of that giving against your AGI. So you can, if you make a significant gift, you can bump against that ceiling. In 2020, you can make a gift directly to charity and deduct it up to 100% of your adjusted gross income. There are some limitations. Those gifts can't be to donor advised funds or to private foundations, but a gift to an organization like SAHC is fully deductible without that limit. And that is an opportunity for many donors to make a very significant gift. Let's talk about gifts from your investments. So we've moved out of your wallet and into your accounts. When you give appreciated stock or mutual fund shares, you avoid the capital gains taxes, you leverage that appreciation into your charitable gift, and your deduction will be the full market value of your gift as given. You don't take a cut for the capital gains taxes as you would if you sold those shares and then gave the cash. Instead, the full value of what you give is recorded as a charitable gift. I know that SHC is able and ready to do this and can provide the transfer information you or your broker may need, and would welcome the opportunity to give you that information. I will say this is not something to initiate at 9 o'clock on the morning of December 31st. It can take a day or two for brokers to act. And we want to make sure, for the sake of your 2020 deductions and tax event, that the transfer is complete in the calendar year. So I would suggest, if this is a way you're considering giving, that you contact your broker or financial advisor now, ask them what in your portfolio looks like it might be good to give, what has the most baked in appreciation, or is there a stock that we're going to have a recommendation to transition out of anyway, and begin the process to make this gift. It is also really helpful if you call SAHC and let them know that you have a transfer underway. They can then help make sure that goes smoothly and is acknowledged and credited to you as quickly as possible. Again, not a gift you want to wait until the very last week of December to do, simply because we want to make sure that the transaction is complete. And with holiday schedules and also the fact that so many people are working from home or working more intermittent hours, I would just bake in a little extra time to do that. The other graphic there shows an IRA account. Many of you who are over 70 and a half may be familiar with something called a qualified charitable distribution. This is a provision that allows folks who are 70 and a half or older to distribute up to $100,000 annually from their IRA account directly to charity. The way that works is you direct your IRA administrator to make that transfer from your account to the charity. Some administrators I know have also provided checkbooks for this, so you can do it yourself. That distribution in a normal year would count against your required minimum distribution. There's no required minimum distribution to be taken in 2020, but you can still make these kinds of gifts. You don't receive a charitable deduction because you don't receive that stream of income and pay income taxes on it. One way to think about this and to ask an important question to ask your financial advisor if this technique is of interest is, would I be better off making a qualified charitable distribution from my IRA, or given the special provisions of 2020 with regard to cash gifts, would it be better for my particular situation for me to take the distribution from my IRA and then make a cash gift to the organization I want to support? Depending on your particular circumstances, one or the other of those may have more tax advantages, but those are both great ways to get assets to charity here at the end of the year. And that is a provision we've had in place for a couple of years, and that remains in place going forward. The other strategy to think about, if you're not yet 70 and a half, but if you're older than 59 and a half, is to take a distribution from your retirement account. It's not a required minimum distribution because you're not old enough for that yet, but you can still take a distribution with without incurring any penalties as long as you're 59 and a half, and then use that as cash to make charitable gifts and take the offsetting charitable deduction. That has some interplay again with the fact that there's a raised limit on cash gifts against adjusted gross income this year. But that is another way, and potentially offers the benefits of that qualified charitable distribution to folks all the way down to age 59 and a half, when normally we don't have that. These transfers are generally easy to make. They work particularly well for non-itemizers because you're not dependent on the charitable deduction to get a good tax outcome. You can't make these gifts to a donor advised fund or a supporting organization. And it's important to know that the check that you distribute from your IRA must be deposited by December 31st. So this is another gift where it's good to go ahead and get a start on it if you want to make that, use one of these strategies before the end of the year, so that the charity can receive that gift and process that transaction, and be ready to acknowledge you appropriately. So with that, I am happy to answer any questions. I want Carl to join in, and he has some a story or two, I think, to share, right, Carl? We can look at this view while we do that. And then I hope there'll be some questions and some clarifications of whatever was too muddled, or where we need more detail to have everybody understand those ideas. So I'm going to turn it over to Carl.
Thank you so much, Cheryl, for making this presentation and for your service to SHC as well. And I wanted to ask if you have the ability to share your contact information, if you have any of that, because I mentioned your years of service with the Community Foundation, and I know you're on kind of a new venture now, and you may want to say a word or two about that. Um, and you could do that now if you like.
Okay, well, thank you, Carl. Thanks for the opportunity to say that. Yes, I left my role I'd had at the Community Foundation of Western North Carolina earlier this summer. I had been there almost 22 years, and I am now stretching in all sorts of different directions. But the most important thing that I'm doing is I have created my own business. I don't have an entrepreneurial gene, but I'm growing into one. Called Alenda Consulting, and it is focused on philanthropic consulting. So working with charitably minded individuals and families to discover their charitable priorities, to talk through their legacy planning, and to then create the kinds of vehicles in partnership with their professional advisors that will achieve those goals, and then to make sure that those plans are carried out going forward. And I'll put my contact information in the chat so that folks have that, but also should know that if you don't grab it from the chat, you can easily get that from anybody at SAHC. They all know how to find me. So thank you for the opportunity to say a word about that, Carl. I appreciate it.
Most definitely, Cheryl. And I will tell a story or two about ways in which legacy gifts have made a profound impact on SHC. But I do want to note a question in the chat. The question is whether one can make a charity the beneficiary in the IRA and thus avoid capital gains in the estate, has been asked there.
Yeah, so you can definitely make charity a beneficiary of your IRA. It is important to look at that strategy with your professional advisor and to structure it in the way that makes the most sense for the other beneficiaries you've named. The IRA passes outside of your estate by that beneficiary designation. And so that is a really effective way. If you're subject to estate taxes, it may have some other advantages. Not many of us are subject to estate taxes anymore, but it does have some advantages. I'd be glad to answer more questions about that, but I want to hear Carl's story. So,
well, we're deeply grateful to everybody who has participated in this webinar. And SAHC is a charity that has an especially long-term kind of in perpetuity mission. And that is reflected in both our land protection work, our transactions to purchase and protect special places, also in our stewarding, our perpetual responsibility around stewarding special places. And so estate type gifts and plan gifts have really played a transformational role in the organization in a number of different ways. One is that the SHC that you know today with professional staffing and the size of our organization and our capacity really is thanks to some estate gifts that were made in forming endowments and operating endowments that really go back to relationships that we built in the 1980s and early 90s. And then people made those gifts. The gifts came to maturity in the 2000s. And I say transformational, and it's not an understatement that building up that capacity for an organization like ours is really what gives us the critical mass and momentum to be able to do the kind of important conservation work that we do. Um, the organization also has long-term investment funds, really kind of managed as endowments for special purposes. One is purchase of conservation easements and land. And so, what the funding like that does is when there's a critical opportunity on the real estate market, and we really need to move immediately in order to buy something. Or else lose that opportunity, then by having those kind of revolving funds available to basically lend to ourselves to purchase an important property, then we're able to do that. And so we have a special fund for that at the community foundation and another investment firm, and so that enables us to move on that. And as you know, we have a obligation that goes on forever to enforce the terms of our conservation agreements, monitor and manage land that we own as nature preserves. And the way that we're really able to carry that out responsibility is through our long-term funds that are earmarked for stewardship of land and conservation easements. And so played a critical role for us as well. One of the stories that I wanted to share is that one of the organization's highest priority properties since our founding came available for purchase in December 2012, really 2 or 3 weeks before the end of the year. And the seller said, "We'll sell it to you if you can buy it before the end of the year." I think they were thinking in terms of an increase in capital gains the following year. And so they were willing to do it with if we could move that quickly, but not willing after that. And I think they thought we wouldn't be able to do it. But we were able to use one of our long-term investment funds that Cheryl had really played a role in helping establish at the Community Foundation. And we were able to use that fund as security to collateralize this loan that enabled us in a space of 2 weeks to buy our highest priority property up on Grassy Ridge in the Highlands of Rhone. It was an epic opportunity, and thanks to us having the access to those assets for that creative purpose, and then people who were willing to work creatively to make it happen, it was a success. We bought it, and it's protected today, and we can take you there to visit if you haven't been there already. And I know many of you on our call, I see in the list people who are just closely associated with the organization, and a number of you have been there. So uh, thanks everybody so much, and thank you, Cheryl. Maybe there's a question or two remaining, if anybody would like to ask. Any final thoughts, Cheryl?
Well, I realized that I promised to talk about something that I didn't talk about. So I'm just going to drop a little teaser and encourage people to ask their professional advisors if this change in the law affects their planning. And that is, and this was something that was enacted at the end of 2019 in December. And many of us were focused on other things, and many of us have stayed focused on other things since then. And it was a provision that eliminated the ability for folks who inherit an IRA, so folks who are named as a successor beneficiary to an IRA account, to receive payments from that IRA asset over their lifetime. So to have the amount that they must draw down calculated based on their age at the time they inherit the account. Rather, folks who inherit an IRA, and this doesn't apply to spouses, and there are some other minor exceptions. But children or grandchildren in a basic scenario will have to draw the assets of that account down over a 10-year period. No longer. By December 31st of the 10th year after the death of the person they inherited from, the account must be emptied. So if you have a large IRA and a young adult child, perhaps, who inherits that, they could conceivably have to draw down significant amounts of money from that account on a yearly basis in order to achieve that 10-year goal. That may not be very tax advantaged for that person, the inheritor, and the problem that I've seen more concern about is adult children who perhaps need more structure in handling their finances and would not be prepared to draw down significant resources on an annual basis in that way. And it potentially you have an asset that should represent a source of security for someone, creating a life path that isn't ideal for them. So if you have children or grandchildren or other folks named to inherit your IRA accounts, it is well worth talking with your professional advisor to see how this very significant regulatory change may affect your planning. And there are some ways to mitigate the effect of that, both from a tax and a practical perspective. It will surprise no one that one of them that I'm most fond of happens to involve also creating a gift for charity. Maybe that's something, if there's interest, we could talk about on another call or provide information to folks. But this kind of goes in that bucket of those first 3 slides. Please make sure you have a will and your healthcare and financial powers of attorney in place. Make sure your beneficiary designations say what you want them to. Make sure, even if they say what you want them to, that you've asked your financial advisor about that new 10-year rule. And think carefully about how you're providing for family as well as for the causes that are important to you. That's the core of estate planning.
Thank you, Cheryl, so much. That 10-year drawdown rule change is an example of something that is so nuanced and subtle that I never would have known about, and an example of kind of the way in which you're so well informed and can give really good advice on these topics. We will put this webinar online, so if any of you who are participating know of a friend or family member you'd like to share it with, it should be available at some point soon to share with them for that. And I guess, Pauline, I'd like to give you an opportunity to add anything that's on your mind related to this type of work that maybe we haven't touched on yet.
Carl, you know what? I'm all good. I think everything was covered.
Super. Well,
Thank you,
again,
Cheryl.
we thank
Thank
you
you.
all. And there is one more question if folks have time for an answer. Actually, it just disappeared. Someone
I
asked.
just answered it, but I can
Got it. Okay, you got that.
I can share the question and the answer if you'd like. So there was a question: is the income from a charitable annuity taxable? And the answer is yes and no. A portion of the income that you receive in those payments is tax-free. A portion, other portions are taxed based on the asset you use to fund it. So if you use something with capital gains, an appreciated asset, then a portion comes back taxed at capital gains rate, and a portion at your basic regular income rate. those that reporting is made to you on a Form 1099 on an annual basis that the charitable gift annuity administrator provides. And what we can do, if for folks who might be interested in looking at that way of giving, is provide calculations that compare amounts or using different assets, and you can get a sense of how the taxation will come out in the execution of the charitable gift annuity, and whether that's for you or for another person. So that's something that we can provide detail on with some scenario planning, and that's an important part of looking at whether that's the right gift for you or not.
Cool. Thanks so much. Well,
Thank
again,
you.
Thank
And
you,
thanks
Cheryl.
everyone for being here.
We will look forward to inviting y'all to the next Lunch and Learn that we have planned. We are working on a series of them really over the winter and into the new year. So it's great seeing everybody here. And again, thank you. Bye-bye.